So it's already 11 o'clock, so ladies and gentlemen, good morning, everybody. My name is Vladimír Tomšík. I'm Vice Governor of Czech National Bank. I'm very pleased to welcome all of you here to our current view of the latest macroeconomic development. Usually, Marek Petruš, he is opening the discussions, but he's on his way because he has a very important meeting, but he will join us in a few minutes. Nevertheless, well, we will continue in our standard, I would say, with our standard presentations. It will be delivered by Mr. Tibor Hledík, head of the macroeconomic forecasting division. And after that, it will take like 30 minutes, 25-30 minutes. And after that, I'm ready to collect all your questions, and me, together with Tomáš Holub, head of the monetary policy department, will try to answer and clarify what we wanted to send as a message to the market. So let's start. Tibor, I'm passing the floor to you.
Good morning, ladies and gentlemen. I would like to welcome you in the small hall of the Czech National Bank's Congress Center. And also I would like to welcome those of you who are following us online. Let me start with the menu for today. My task is just to give you an overview about the Czech National Bank's new forecast. So I will start with the assumptions of the forecast, both in terms of the foreign assumptions and the domestic economy. Then I will turn to the macroeconomic story, and I will describe in more detail the individual sectors of the economy. And finally, I will just pin to the main differences that are driving the change of our new forecast compared with the previous one. Okay, so let me turn to the assumptions, and namely to the external environment outlook. External demand growth will pick up this year and will stay close to 2% afterwards. There is a very strong contribution to this revival of the very relaxed monetary policy conditions in the Eurozone, which is given by the quantitative easing policy of the European Central Bank, which is not only causing low interest rates, but also contributing to the depreciation of the euro against the US dollar. If you have a look on the PPI development in the Eurozone, you can see that there is still a very deep fall in producer prices in the Eurozone. It's mainly given by slump in energy commodity prices, but also the growth in the euro area is still only moderate, so it's not generating substantial inflationary pressures yet. On the forecast horizon, the consensus forecast analysts assume that prices will start rising as from the beginning of the next year, and they will be slightly above 2% in 2017. As I mentioned, the European Central Bank is maintaining a very relaxed monetary stance, which is practically seen on development of short-term interest rates in the Eurozone that are practically fluctuating around zero until the end of 2016, and then you can see a slight increase, which is in the forecast, it's reaching 0.3% at the end of 2017. The relaxed monetary policy stance also showing up in the exchange rate development. The consensus forecast assumes that the euro-dollar exchange rate will depreciate on the forecast horizon, and this is of course given by the difference in the cycles between the Eurozone and the US, and also the markets expect that the Fed should start the hiking cycle sooner than the European Central Bank. In terms of fiscal policy, you will see that the forecast is consistent with a drop of deficit practically all over the forecast horizon. In 2015, the deficit should drop to 1.4% of GDP, and the main reason behind this drop is just higher economic growth. And this drop will happen despite the fact that the government introduced a new 10% reduced VAT rate, which is of course just pushing the revenues somewhat downward. Also, the government announced that there will be increase in pensions, increase in public wages, and also public investment will be relatively high, given the fact that the government will try to draw down as much EU funds as it is possible, given that the previous program period will end in 2015. In 2016, you will see a further decline in deficit to 0.6%, and here there will be a fall in public investment due to the smaller drawdown of EU funds, and you will see exactly the opposite. What we'll see in this year means that there will be a new programming period, and therefore public investment projects which are linked to EU funding will be just grow gradually. Also, in 2016, the forecast assumes that the government will have additional revenues from excise duties on cigarettes. In 2017, we'll see a further drop in deficit to 0.2% of GDP, and here we assume higher revenues from sales of emission permits, which will be only partially mitigated by on the expenditure side by launching a new green saving program for the general public. And also in 2017, there will be a faster drawdown of EU funds within the new programming period. So practically after 2016, we assume that already public investment will be higher due to better drawdown of EU funds. In terms of the fiscal impulse, you see that in 2015, the fiscal impulse is positive, reaching plus 0.6 percentage point. It will go down to minus 0.3 in 2016, and again will switch to positive contribution in 2017. Practically, the development in the fiscal impulse is linked very much to the use of EU funds and how it is linked to the forecast of public investment. Okay, in terms of monetary policy, the forecast assumed market interest rates to be flat at a very low level, and the exchange rate to be used as a monetary policy instrument until the end of 2016. Consistent with the forecast is an increase in interest rates in 2017. The short-term forecast of the exchange rate of the krona against the euro takes into account the appreciation what we witnessed in July. It is expected to remain stable in the following quarters. At the level, this is slightly weaker than the announced asymmetric exchange rate commitment, which I'm sure you know is 27 Czech crown to the euro. After the exit of the exchange rate commitment, the krona will moderately appreciate due to the positive interest rate differential and renewed real convergence of the Czech economy to its advanced counterparts in the euro area. I would just like to stress that compared with the pre-crisis periods, we believe that the exchange rate appreciation will be less pronounced. Okay, so let me turn to the new macroeconomic forecast. Namely, just first I will try to give you a short summary. Both headline and monetary policy relevant inflation increased in the second quarter of 2015. Both inflation rates, however, remain below the Czech National Bank's target. Inflation will increase further until the beginning of 2016, although at the monetary policy horizon it will remain below the 2% target. The target will be reached only in 2017, and later on I will just give you some background what are the main reasons for this. In terms of the structure if you see the cost side of the inflation development, import prices in the consumption sector will remain anti-inflationary in the near future, owing to falling producer prices in the euro area, also previous decline in energy commodity prices and the recent appreciation of the Czech crown against the euro. The turn will be linked to the growth in the foreign producer prices, and after this, from mid-2016 onward, the import prices will have a slight upward effect on the cost in the consumer sector. The domestic economy will contribute to the price increases over the entire horizon as the result of a continued robust growth and gradual acceleration in wage dynamics. We recorded a very high GDP growth in the first quarter of this year, and in the forecast we assume that there will be a slight correction in the second quarter. Nevertheless, the high GDP growth will continue in the rest of the year thanks to expanding domestic and external demand. During 2016 and 17, the GDP growth will be mainly driven by household consumption and investment, private investment. In our forecast, the forecast is consistent with a GDP growth of 3.8% in 2015, and then there will be a slight slowdown to 2.8% in both 2016 and 17. The rising economic activity will show up in a continuing improvement in the labor market situation. In connection with the high economic growth, total employment will increase by 1% this year, followed by a slightly less pronounced growth in the coming years. We assume that the general unemployment rate will decrease on the entire forecast horizon. The wage growth in the business sector will reflect the very robust economic growth and the very good sentiment both in the business sector and among households. We assume that it will gradually increase, and from the second quarter of 2016, wages in the private sector will fluctuate just above 4.5%. The wage growth in the public sector will be stable near to the current levels. Okay, headline inflation reached 0.7% in the second quarter of 2015. The main contribution to this acceleration was coming from food prices, because in the first quarter we still see a fall in food prices, and the second quarter this switched to a positive growth. And also the fuel price decreases were less pronounced than what we witnessed in the previous quarter. According to the forecast, headline inflation will continue to rise until the start of 2016. However, as I mentioned, it will be then dip temporarily and will thus be below the 2% target at the monetary policy horizon. The story for the monetary relevant inflation is quite similar. It went up to 0.4% in the second quarter, and it was significantly below the lower bound of the tolerance band around the Czech National Bank's target. And over the forecast horizon, practically this will copy the development of headline inflation, and the only difference is coming from the positive first round effects of changes to indirect taxes. And similarly, as was the case in headline inflation case, it will be close to 2% inflation target as from the start of 2017. Okay, let's have a look how the structure of inflation looks like based on the recent data. Headline inflation increased to 0.10% in June. This increase was, as I mentioned earlier, was mainly given by continuing pickup in food prices, started in April. You can see it in both graphs. On the left-hand side graph, the green bars were negative in the first quarter, and they just are positive in the second quarter. Core inflation remained distinctly positive, and practically in both main groups, both in tradables and non-tradable goods, we are seeing continuing growth. Compared with the beginning of the year, the fall of fuel prices was less pronounced. Practically, fuel prices are almost entirely copying the development of oil prices on world markets. The year-on-year change in administrative prices was close to zero during the first half of this year, and we had some different factors acting there. First of all, there was a rise in price of heat for households, and also the increase in gas prices. At the same time, in the opposite direction, there was an abolition of regulatory fees in healthcare. So, I mean, these factors were just almost eliminating themselves, and I think the year-on-year growth is something like 0.3% in the second quarter. Okay, net inflation turned to positive again in the second quarter of 2015. It reached 0.5%. Based on the forecast, it will rise further in the period ahead due to the further increase in food price growth and core inflation, which will practically reflect the continuing growth of the domestic economy. The growth of administrative prices will fluctuate around zero the next year, as it will be dampened by further decline in prices of energy for households. The forecast expects that administrative prices will increase by 2% in 2017. Here we again take into account a renewed growth price of energy for households, and practically for this period we haven't got very strong information, so we assume more or less to growing at a steady state level. Core inflation was unchanged in the second quarter of this year, averaging to 1.1%, and it is expected to rise further, fostered by the continuing inflationary effect of the domestic economy and labor market, and also by renewed price growth abroad. And I will talk about the effect of import prices on the next slide. Food price growth will still rise further in the second quarter of this year. This will reflect mainly the development of agricultural prices, which will return to a slight growth by the end of the year due to the new harvest. You can see on the graph that there is a kind of base effect there. We just believe that the jump and the surprise what we experienced at the beginning was just partially one-time effect. Also, in the longer time horizon, we assume that import prices of food will decelerate, because in the beginning of the forecast horizon, food prices probably explain some of the jump what we witnessed in the last few months, because we realized that food prices of fruit and vegetables, import prices of food and vegetables were rising above average, and it was also the same direction in the Czech CPI. Okay, the promised decomposition of the main factors of inflation in the consumer sector. The growth of prices will be driven by the strengthening inflationary effect of the domestic economy. The contribution of import prices is expected to be negative until the mid-2016. And you can see that the main reason behind is the appreciated exchange rate and the deeper fall in foreign PPI. And you also can see that after mid-2016, these import prices will contribute slightly positively. The domestic cost will mainly due to increasing wage dynamics, although you can see that the high productivity will mitigate the cost pressures coming there, which is natural. In terms of the GDP growth, the forecast assumes that GDP will grow by 3.8% in 2015, and then there will be a slight slowdown to 2.8% both in 2016 and 17. The Czech economy will be boosted by a pickup in external demand, easy monetary conditions, and low oil prices in 2015 and 17. This is a quite similar story what I was mentioning in terms of the Eurozone. In addition, we'll have some positive fiscal impulse in 2015 and 17 given by expansionary policy, and here the main story is that this fiscal impulse is mainly linked to the drawdown of European funds. The economic growth will slow down just below 3% in 2016. The main reasons is the unwinding effect of extraordinary jump in inventories in the first quarter, and also just the diminishing effect of the fall in oil prices. Also, we'll see a decline in government investment, and there will be also a slight effect of the recent appreciation of the Czech crown. Okay, let's look on the expenditure side of the national accounts. The growth in the household consumption will increase to 3.5% in 2015 and slow down slightly below 3% in the coming years. I mean, this development will be given quite a lot with the very good growth of nominal disposable income, where we assume that both employment and wages will contribute to the growth of nominal disposable income. And also, we assume that the saving rate will gradually fall on the forecast horizon. Investment growth will reach 7.3% this year, where, of course, we have got some extraordinary effects which we assume will not be repeated in the coming years. Some of them are the drawdown of EU funds and high inventories. Also in 2015, there will be a one-time effect of a prolonging of the lease of the Gripen fighters, which again will act in the opposite direction in 2016. Practically, this is negative in terms of GDP growth, because the same amount will be subtracted in imports, through imports. Export reflects the pickup in foreign demand, and imports growing domestic demand, and also partially we are taking into account the import intensity of exports. In terms of the labor market, as I mentioned, the labor market is performing very well in line with the growth in GDP. The growth in number of employees converted into full-time equivalent rose to 2% in the first quarter of 2015. And practically we have seen faster growth in number of employees and also a slightly lower average number of hours of work. You can see the decomposition on the graph. The growth in the number of employees converted into full-time equivalent will continue to grow at the forecast horizon, although somewhat a slower pace than in 2015. The wage growth in the business sector will increase to 2.8% for 2015 and then accelerate further to 4.6 and 4.7 in the coming years. The annual growth in the non-business sector will be stable in overall, as I mentioned earlier, and it will be around 2.8%. The main driving force behind the wage growth, of course, is the high economic activity, also higher inflation in 2015, and the overall improving sentiment in the labor market, falling unemployment rate. The forecast of general unemployment rate is not reflecting the recent data revisions of the Czech Statistical Office. You can see that based on monthly data, our forecast was, I think, 5.9% exposed after the revisions. The seasonally adjusted general unemployment rate is 5.2. So practically you can see that the recent data are pushing us somewhere in the mid of 2016, what we assumed in the forecast. So practically after we will redo the forecast, definitely I assume that we'll be at a lower level. Of course, we will have to analyze this. You can see that in the forecast we assume that the unemployment rate will fall in the whole period ahead, and practically this is a cyclical story. The forecast expects market interest rates to be flat at their current very low level until the end of 2016. This reflects the assumption that two-week repo rate will be left at technical zero, and the money market premium will remain unchanged in the same period. Consistent with the forecast is an increase in interest rates in 2017. Okay, so I can turn to the last part of my presentation, and this is just a kind of quantification. What are the main factors that are explaining the shift of our forecast compared with the previous one? Let me again give you just a brief summary. Compared with the previous forecast, both the predictions of headline and monetary policy relevant inflations are higher until the mid of 2016. And this is due to higher observed inflation and smaller decrease in administrative prices. The forecasted levels of both these inflation indicators are slightly lower afterwards, including the monetary policy horizon. The stronger GDP growth in the first quarter of this year and the faster recovery on the labor market led to upward revision of the annual GDP growth this year, and the prediction for 2016 was slightly lowered. The growth in nominal wages in the business sector has shifted upward over the entire forecast horizon as a result of higher observed wage growth and faster recovery in the domestic economic activity. And the assumption of flat market interest rates and their current very low level, and the use of exchange rate as a monetary policy instrument until the end of 2016 is unchanged. Okay, so let's take a closer look on the changes for the headline inflation forecast. It can be seen that the forecast of annual headline inflation is higher than in the previous projection, and this is the case until mid-2016, and later on the forecast is lower, including the monetary policy horizon. Compared to the previous forecast, the domestic economy this year is characterized by slightly stronger cost push pressures stemming mainly from higher wage growth, and the stronger exchange rate goes a little bit in the opposite direction. So it's a little bit mitigating the pressures coming from the domestic economy. The path of net inflation over the forecast horizon is affected by higher observed inflation in recent months and a current situation of the domestic economy. I will talk about the factors that are influencing the net inflation on the next slide, but you can see that still we have got a kind of base effect there, and again I will talk about it on the next slide. The revision of the administrative price forecast reflects the postponed decrease in gas prices for households to the beginning of the next year. The higher outlook for core inflation reflects higher observed data in the recent months and stronger domestic economic growth in 2015. Again, in the opposite direction, the recent appreciation of the exchange rate is just mitigating these pressures. In terms of forecast of food prices, we were surprised, as I mentioned, upward in the second quarter. Mainly we believe that this is due to higher imported food prices, especially for fruit and vegetables. And the forecast assumes that these imported prices will just start to fall in 2016, or just to be exact, the inflation rate will decelerate in 2016. And besides the base effect, the lower import prices in 2016 are explaining why we are below the previous forecast. The forecast for annual GDP growth in 2015 is significantly above the previous prediction. The revision is due mainly to the considerably stronger GDP growth in the first quarter and slightly higher external demand. exactly the opposite is happening for 2016. We are slightly lower, and primarily because of the higher base effect. We just don't believe that in the next year we'll see in the first quarter similarly significant rise in the change in inventories. And also a stronger exchange ratio of the corona plays some role. Let's have a look at the structure of the national accounts expenditure side and the comparison. The forecast for household consumption has been moved upwards for 2015 and 16 due to higher growth of wages and employment, as I mentioned, and also lower saving rates. In terms of investment, the overall economic climate and also the sentiments will be pushing investment higher compared with the previous forecast. And here also you can see, maybe I can show you here you can see the effect of the Gripen lease, and here in the opposite direction. So the volatility is partially driven by these one-time effects, but overall the higher investment will be reflecting the better economic sentiment. The contribution of net exports to GDP growth in 2015 is less negative than in the previous forecast, and this is given by slightly higher growth in the external demand. In 2016, the contribution of net exports will be less positive because of slightly stronger growth in domestic demand. In the labor market, the growth in average nominal wage in the business sector has been increased compared to the previous forecast. I was just mentioning the main factor. This is economic growth and also higher inflation in 2015. And probably these are the main factors behind this. And the path of domestic market interest rates is unchanged until the end of the next year. So, ladies and gentlemen, that was the presentation of the Czech National Bank's new forecast, and thank you very much for your attention, and we are looking forward to your questions. Thank you.
Thank you very much, Tibor. And first of all, those of you who came a little bit later, let me welcome you to the Czech National Bank. And as I said, well, the presentations will be followed by discussions with me and with our chief economist. So first of all, let me propose that I would also like to probably take 2 or 3 questions, because it can help me to combine the questions, and probably some of them can be very similar to answer. And before we really start, I will also ask you to introduce yourself, because I know just some of you, and I'm thinking by names, of course, but most of you I know by your reading, by your articles, comments, etc. So who would like to start? Helena Horska, please, go ahead.
Sorry for being almost the first. So Helena Horska from Raiffeisen. I can see one big question in your communication regarding the future development of Czech crown, so-called post-exit currency development. So my question is, why the Czech Nation Bank change the expectation of the Czech currency development after the exit? Because, as I remember correctly, there was the idea that thanks to currency weakening, there would be change in nominal variables, and then, and because of that, we should expect not strong or even any appreciation of the Czech crown after the exit. And if I may, the second question, from the communication, it's very clear that you, as a board, you have a different opinion on the timing of the exit, because we can see that the prognosis says that the exit should be end or should be timing by the end of 2016, but the board says that there should be the end in in the second half of 2016. I know there's a small difference, but there is. So why there is difference between the meaning of the board member and the different opinion from the prognosis? Thank you.
Okay, so now we do have two questions. Who else would like to ask? Please.
Morning, and thank you. Pasquale Diana, Morgan Stanley. Could you kindly comment on the forecast for wages? Wages rise quite sharply in your outlook, but if I read the chart correctly, we've already seen the best of employment growth. So could you comment on those on risks around that forecast? Maybe what makes you certain wages will accelerate, and perhaps on the sort of global price outlook. We've seen a lot of downside pressure from excess capacity in Asia. Can you comment on what that means for import prices for a small open economy like the Czech Republic's, and what that means for risks toward the inflation trajectory? Thank you.
Right, so there was the second, and again, two questions, and probably the final one in the first round. Is there any other question? Yeah, Mr. Bresch.
Jan Burech, CSOB. I may add one more question to Helena's questions about the currency development after the exit. For now, the central bank's board admits that there is a real convergence going on in the economy. Does that mean for you, the longer you stay in the regime of interventions, the greater the potential for subsequent appreciation of the Czech koruna? And if yes, is there a kind of factor for you to think about?
Thank you very much. So we do have 4 or 5 questions. Let me start with some of you, and definitely Tomáš Holub, as a chief economist, he will probably elaborate on that a little bit more. I mean, at least I can put 2 or 3 of them probably in one answer, and the questions, they were as follows. What we can expect regarding the nominal exchange rate after when there is an exit? And first of all, let me probably repeat or remind, if you want, what we said even several months ago. First of all, well, exchange rate is a tool. It's a tool to deliver price stability. And why I'm saying that? Because we want to use this tool until we see that we are sure that the monetary conditions will allow us to embark on traditional tool, which is nominal interest rates. Why I'm saying that? Because to switch from unconventional monetary tool to conventional monetary tool, it requires to see there will be a pass-through effect, and you mentioned then we are prices, I would say, and well, prices are follow or even go in hand with nominal wages, yeah? Why I'm saying that? Because, well, there was you see some changes regarding the future of nominal exchange rate. We say no. Well, we are talking about exit strategy once we see that our forecast regarding the inflation is heading to inflation target, which is 2%. Some of the bank board members could even say it can be even above 2%, because we have a tolerate band, by the way, yeah? And why I'm saying that? Because this is a nominal part of the whole economic story. Another part is, a real economic story. Why I'm saying that? Because, well, we do have, of course, GDP growth. Right now, we forecast for this year 3.8, but for the next year, 2016, 2.8. For 2017, 2.8. Well, why? Because we are saying after 25 years of transformation process, after several years of lost investment during the longest recession in the Czech economy, we are afraid that our potential GDP growth for next few years is around 3%. Potential growth for our main trade partners, Eurozone, is about 2%. So you see the differential in output potential is like 1%. Okay, this is a real story about the real economy. The nominal story is that, well, our inflation target is 2%. And we believe that, well, ECB nominal target is close to 2%, but below to 2%. So if you put together, well, the real convergence process will be followed by real appreciations. But real appreciation of currency consists of nominal appreciations and inflation differential. So put together the potential output differential, 1%, and price differential about 0.5. Well, real appreciation is about 1.5%. So this is my, broader answer, that I don't really see a significant change what we can expect once there is a time for exit regarding for nominal appreciations. This is the first part of my answer. The second part is there are several, I would say, analysts, or there are several real papers regarding what is the, I would say, behavior, real exchange rate value, what is the fundamental real exchange rate of the Czech economy. And those studies, they have shown that at the time we embark on a fixed intervention, well, Czech currency was overvalued. So definitely the second part of the story what we can expect after the exit is that there is no, I would say, a real fundamental behind that we could expect a significant nominal appreciations. Yeah. And regarding the exit, yeah, I understand that presented forecast, and not only, the latest one, but even the previous one clearly said that the forecast is based on the exit not before the end of the next year. But on the other hand, Czech Bank Board, I think, has never ever blindly followed the forecast, because our role is to discuss the risk or some uncertainty what we see in the economy. And as far as I know, we have never ever said that Bank Board said we should exit. We just say, well, we expect or we will not exit before mid of 2016. We have never said where we should. We just said that we should exit once we are sure we can embark back on the traditional monetary policy, which is nominal interest rates. So I definitely see, you see a little bit, difference between what you can see in the forecast and what you can see in the communication of the Bank Board members. But on the other hand, as I said, our role is to clarify and to address some risk and uncertainty. And nobody knows, I'm pretty sure nobody knows how a real economy will look like early next year or even 2017. This is for the first time that we are presenting our view on 2017. I'm just saying that if someone clearly describes what's going on in the real economy next year and exactly in 2017, I will be ready to explain when and under what conditions we should exit. But so far I can really repeat what we have already said to the market, that the Bank Board has never ever discussed to really think about exit before mid-2016. As was presented, the latest, I would say, real development and monetary development have shown that definitely there is a need for, for easing monetary policy. And this is what I would say regarding the exit strategy and regarding the nominal, I would say, of the development of nominal exchange rate after the exit. There was another question regarding the wages, and I think I've already a little bit addressed it. Wages is a key variable regarding the whole pass-through process from nominal exchange rate to price development and to real economy. And if we trust that there is a real, I would say, the real economy is doing fine, and if everybody thinks that this real economy should be passed through to the real appreciation, there is only one channel how to do that, through the Balassa-Samuelson effect. And Balassa-Samuelson effect works and is dependent on wages. Until we see the wages are going up, well, there is no any real fundamentals which will be behind real appreciations. That's why I think it has been already communicated that the latest development in the FX market, this is not something what was really behind the fundamentals. It was more linked with the sentiments. So that's why it was presented that our forecast for 2017 calculates with the nominal wage growth with 4.5, because this is a key variables which you need to see regarding the balance effect, regarding the using unconventional monetary policy tool, which is nominal interest rates, to get increase all nominal variables and to allow us to think about exit. Yeah, that's true that right now we see that there is a very, very modest wage development. That's the explanations where the new forecast still calculates with the exit definitely not before end of the 2016. And the latest question was regarding the convergence, real convergence process. I think I've already addressed that. So real convergence process addresses real development, which is based on GDP output gap and on nominal price development. So the fundamental, I would say, real appreciation shouldn't exceed 1.5%. And Tomáš, I guess you would like to elaborate on that a little more.
Okay, thank you, Vladimír. I think you've touched many things already. As regards the timing of the exit, I would really just confirm that these are two different things. The forecast is supposed to be at least the best unbiased prediction. And unbiased means that you have risks on both sides. What we say is that if everything develops according to the forecast, conditions for an exit will be in place in early 2017. Of course, if we in the meantime get some upside surprises, it may be a bit earlier. If we get downside surprises to inflationary factors, the exit might come a bit later. That's what the forecast is about. You should have risks on both sides equally balanced, so somewhat earlier exit should be equally likely as somewhat later exit. While the board's communication is basically a time contingent commitment not to exit before mid-2016, but it doesn't mean that the exit couldn't come in early 2017 fully in line with the forecast. So I don't see there any disagreement between the staff and the board. The board assessed the risks of the forecast as balanced, so for the time being they didn't see any strong reason to deviate from the forecast itself. But the two things are of a different nature. What the board communicates as its commitment, it's something different than the forecast assumption. As regards the real exchange rate appreciation, I think we are still believe that there is no reason for the exchange rate to start returning to the pre-intervention level, in the sense that I think there is a kind of widespread belief that this was the right level, and somehow we distorted it, and once we are away from the market, there will be some kind of natural gravity, physical force bringing the exchange rate to this level. And we see at least two reasons why this is not the case. First of all, we really assessed the level before November of 2013 as slightly overvalued, using our methods for estimating the equilibrium exchange rate, mainly the fundamental equilibrium exchange rate. We will have a box on this in our inflation report published next Friday, and this assessment is in line with the IMF staff as part of their article formation this spring. So first of all, from the real point of view, the real exchange rate before November 2013 wasn't the right equilibrium one. And the second part is the nominal story. We believe that the weakened exchange rate has been passing into other nominal variables, but one area where the pass-through is not yet complete is the wage development. I think any exit before the wages accelerate in line with the forecast would actually be a premature exit, which would amplify the reason for nominal exchange rate appreciation. So I wouldn't agree that the longer we exit, the bigger nominal exchange rate appreciation shock there will be. If we allow the nominal pass-through to get finished and to go as far as the wage development, this will actually moderate the fundamental pressure on exchange rate appreciation. As regards Pascal's question, why we so far see a fast employment growth and weak wage growth, while the forecast is the other way around. We expect moderation in employment growth and speed up in wages. I think this is about the usual time lags. When you recover from a protracted and relatively deep recession in the early stage, you have ample unemployed labor, which the companies can hire without offering higher wages. So employment growth is fast, but wage growth is slow. I would even say that in the current cyclical upswing, this phase is a bit longer than usual. The wages are recovering more gradually than the normal cyclical pattern, while employment growth has been surprising us on the upside. This might be really a reflection of the protracted nature of the recession. It seems that until now, employees have been very non-aggressive in bargaining for wage increases and preferring job certainty over wage increases after the long period of job uncertainty. But now with the general unemployment rate down to almost 5% or 5.2 in seasonally adjusted terms, we are actually approaching our estimates of NAIRU, the non-accelerating inflation rate of unemployment or non-wage accelerating rate of unemployment. In the last inflation report, which was published in May, we actually had a box with an estimate of NAIRU, which was around 5%. So more or less the slack in the labor market is now gone to a large extent, and you should see that the ongoing economic growth is less and less saturated by growing employment because labor becomes scarce, and therefore companies should start competing about the unemployed people more aggressively, and they should contribute to acceleration in the nominal wage growth. I don't know whether Tibor wants to add something on this.
Maybe the only thing is that also we see some demographic effects, that there's more and more people among mothers on maternity leave or pension age people who are coming back to the labor market. So it's a kind of additional supply of labor, which is also playing a role. So I mean, altogether these things are probably causing that still we cannot see inflation pressures or pressures on wages, but this is just a question of time.
Let me add one sentence to these discussions on wages. It's very easy just to look what kind of rate of unemployment we do have. We have just 5% of unemployment, which is unbelievable. I mean, after several years of really, recession in this economy, 5% is the second lowest one in the whole European Union. We do have 28 countries in the European Union, and we have the second lowest unemployment rate. Why I'm saying that, I think it makes sense to rely on speed up in nominal wages growth, and it makes sense to rely on balance of in the future, which help us definitely to say we shouldn't expect any sudden nominal appreciation once there is a real time for exit. There is still one question coming from Pascal regarding the price development in Eurozone. Yeah, Tomáš, please go ahead.
It was actually related to the excess capacity in Asia and potential spillover effects on Czech inflation. I think you are right. This might be a kind of anti-inflationary factor, but well, my feeling is that with some degree of abstraction, you can say that Asia is a US dollar currency area, or well, many of the currencies are linked to US dollar rather than to euro, and euro has depreciated quite significantly against US dollar in recent quarters, and together with that, Czech koruna has depreciated against the US dollar almost by 25%, which I think is providing more than a sufficient offset to those anti-inflationary forces. Actually, one reason why core inflation has recently surprised us on the upside might be that in the previous forecast we a little bit underestimated the impact of depreciation against US dollar on Czech inflation, where we were surprised mostly on the upside was the group of clothing and footwear and electronics, and those are consumer expenditure items that are typically imported to a large extent from Asia or in general from US dollar area, and again, as a kind of advertisement in the new inflation report, we'll have a box on the pass-through from US dollar into Czech inflation.
Thank you, Tomáš. So you see how open and transparent we are, that we are publicly admitting that we have underlined, underlined something, yeah, and we have something and underestimated. This is not very common. Nevertheless, let me take the second batch of your questions, please.
Hello, Mai Duan from Bank of America Merrill Lynch. I would like to ask about the way that the central bank communicates. So we understand the central bank forecast and understand why the central bank communicates its neutral stance. However, it's a bit difficult to communicate to the market in the sense that you've got consistently good data. Then you revise down your inflation forecast for the reason that you have explained. But also be mindful of the fact that the euro check is very close to the floor now. So I'm just thinking of from the central bank's perspective, how do you think about, presenting yourself and making yourself credible? Because I think under the interest rate policy, it's not that difficult because you leave it out for the market to play itself. But in terms of defending a currency, it's also in terms of the cost to the central bank as well. So I just think that, in this particular situation when euro check is close to 27, how do you make the strategy of communication better to the market investors in general?
Usually take 2 or 3 questions, but this is very important. I think I should react immediately. First of all, how do we communicate? We have been always communicating using our forecast, and try to explain what kind of risk and uncertainty we see in our forecast. And we have always been saying we are ready to do everything to deliver that we are going to meet our inflation target in a monetary policy horizon in next 12, 18 months. And if you look at the latest forecast, which was presented right now or yesterday, well, unfortunately, we are still, below the inflation target. That's why we yesterday said it makes sense to continue in our monetary policy that had been, installed, I would say, 1.5 years ago. Why I'm saying that? Because you also mentioned that, you mentioned cost of the central bank. I clearly said, well, we started cutting interest rates, it was in October 2008, not in September, in October. You see the difference, yeah? And unfortunately, we reached zero lower bound. Yeah, why I'm saying that? Because, well, we embarked on another, I would say, unconventional monetary policy tool, yeah? We are ready to use this unconventional monetary policy use. And some people, some analysts say, but when it can create some cost for central banks for the future. It's not necessary it will create, because nobody knows what will happen with the nominal exchange rate for the future. There are just some, analyst forecasts regarding the sudden appreciations, which as explained, probably there is no reason. But nevertheless, even if there is any future costs, we do have an experience with this cost for central banks. And we didn't, at that time, we didn't see any limits to deliver monetary policy. Well, according to some accounts of even negative capital, well, it doesn't create any problem to deliver what general public expects from us, to deliver price stability. So this is a clear message, and right now I can say that I am very pleased. I do have personal experience with this. At that time, when I joined the central bank, we had a negative capital, and I didn't feel any limits regarding delivering monetary policy. So once you are mentioning costs, well, right now we don't have any costs. If there is any future, it can happen. I can't rule it out, but I see no limitations. And regarding communication is still the same. Well, you can jump from one, I would say, goal to another goal, but this is not our role. We have, switched from monetary targeting. It was in 2000. No. So you see, several years ago, I even don't remember that. So, and now it's very, when? 98, you see, more than almost 20 years. And so the communication hasn't been changed. Still, we do have an inflation target. We are ready to do everything to deliver price stability. And why I'm saying that? Because it seems to me, once we are talking about the wage growth, people, they know inflation number. People, they know what they should ask employees regarding the wage growth, but nobody knows regarding what is the cost of the central bank, what is the monetary growth. People, they don't know it. So my answer would be regarding communication, no change to the same communication. Well, of course, we are here to address and to clarify the risk and uncertainty, but definitely no switch from communication. Nevertheless, let me continue in the second round of questions, if there is any. Tomáš, he wants to add something.
If I may add one thing about the communication, I don't know whether you've noticed this or not, but in the board statement, there is a clarifying sentence about the commitment not to discontinue the use of exchange rate as a monetary policy instrument before the second half of 2016. And in particular, the board has clarified that this means that the exchange rate will be at 27 korunas per euro or weaker, at least until mid-2016. I think this was because some local analysts were speculating that just being committed to maintaining the floor might mean that we shifted to, I don't know, 26, or if we want to 13, a kind of circumventing the commitment by shifting it to a non-binding level, and the board has clearly clarified by this sentence that this is not the intention. So if someone wants to open a position on future exchange rate appreciation at the current level, we basically say that you may do it, but it will not be profitable for the next at least 1 year. That's, I think, a clear message.
Tomáš, thank you very much for this clarification. I'm here to present the board views on that. I have to say this is the only one sentence that I have underlined. Why? Because I think it makes sense to point it out, because Czech National Bank right now is here to clearly say that we are providing something as a hedge for free of charge, by the way. yeah? Because there is a commitment. And we don't see, according to the latest forecast, any really risk, any fundamentals which would, start thinking about to change the exit right now. No, really, this is a clear hedge for the whole market. And I put it together with the cost that you just mentioned. Well, it can happen, there can be cost for the future, but there is no limits to monetary policy, to real monetary policy. If there are some analysts, if there are some clients which would like to hedge right now and pay for that, it's free market, go ahead. But we provide it free of charge until the mid of 2016. Is it clear? This is the one change in the statement. I underlined it. Let's take some other questions. Please.
Viktor Zeisler, Komerční banka. I have questions. I'm sorry, back again to the exchange rate and inflation. The forecast assumes like exiting in early 2017 or at the end of 2016. And looking at the slide 26, we see there is no downturn of the adjusted inflation. So do you expect no whatsoever appreciation of the koruna, or do you expect that the pass-through of the import prices will be that low? Another question about the food prices. Well, the revision to food prices was, well, not significant, but there was a revision downwards of the food prices compared to the last forecast. I don't know whether I really catched what you said about the food prices in the presentation, but the revision of the forecast was for both years, 2015 and 2016. So what are the reasons when we see like the harvest will be much lower and the import prices of foods is now also increasing? And the third question about could the revision of the unemployment rate affect also the wage growth and with respect to Naira, because it will probably hit Naira much earlier than you expected, and would it mean any consequence into your forecast, or should we expect even revision upwards in the wages? Thank you.
Thank you very much for all of your questions. It seems to me that all of them they are more technical, so well, once we start answering those questions, I'm going to ask Chief Economist or Tibor Hadik to really address them in more details. But nevertheless, before that, let me take one or more questions, please.
Hi, Oliver Weeks from Brevin Howard Asset Management. Two questions, if we've got time. First, on negative interest rates, the governor mentioned there was a small discussion about that. Could you elaborate what your position is on that now? I think Mr. Holub also raised the issue quite recently. And the second question, this idea that the exchange rate was overvalued in 2013. Could you explain the evidence for that? Because I particularly don't remember you saying it at the time. In fact, I remember quite specifically you were saying that this the FX peg was not about you having any problems with valuation. It was just about CPI. So have you changed your view there? Or? Thank you.
Okay, so probably let me start with these questions regarding negative interest rates. First of all, very basically, as I said, in November 2013, I remember I said it several times here. In November 2013, at that time, we had several options how we can further, ease a monetary policy. Economic theory provides us further options, but for the Czech economy, as a small open economy with a really high liquidity, the deposit to loans ratio is more than 130%. At that time, it really, it was obvious that the most, I would say, useful, effective, unconventional tool would be to embark on FX interventions, to deliver floor. And my question is, if we really talk about negative interest right now, is there any significant change comparing November 2013 right now? it seems to me the banking sector is still in the same positions, you know? There is over-liquid. Yeah? And if I compare real economic development in November 2013 and today's, it seems to me that, I mean, the intervention has helped us. So it's really effective too. So if there was a necessity for further easing of monetary policy, further easing, I'm pretty sure the Czech National Bank would use still the same unconventional tool which was used in November 2013, because, I mean, the history has shown us that it was very effective. I understand that negative interest rates are more common right now in Europe, but still, I mean, the monetary, the financial sector hasn't been changing the Czech economy. So as I said, just me repeating, we see now it makes sense to continue in the monetary policy we are using right now. We don't see any really imminent, I mean, further pressure for furthering easing of the monetary policy, but if there was, we would go using the same unconventional monetary, the same nominal exchange rate, yeah? Of course, it doesn't mean that I'm ruling out to use nominal interest rates if there is some, and how to call it, emergency case, because I don't know what will happen next quarter, next year. I can imagine, based on some experience of some other central banks, and this is not common that I'm going to name it, but you see what was in Denmark, for example. In this case, they saw sudden significant inflow of investment or speculative capital. Probably it can be a trigger for using nominal interest rates. But once we are talking under, I would say, real economic development, if there is a necessity to use further easing, we do have right now very useful tool which we can use. And regarding the yesterday bank board discussions, very openly, there was no discussions regarding using nominal interest rates. Why? Because, as I said, we do have another tool which is very effective. And Tomáš, if you want to add something on that, and definitely I would like to ask you to answer the first three questions regarding the food prices, regarding the some other, I mean, price pass-through development, please.
Okay, as regards the exchange rate developments after the exit, the answer is on slide 6, which says that after the exit from the exchange rate commitment, koruna will moderately appreciate due to two factors: interest rate differential and renewed real convergence, which we, however, expect to be significantly slower than in the pre-crisis period. So we do have some appreciation against the euro in the forecast. For obvious reasons, we are not going to tell you how much. You can also see the pass-through on slide 15, which decomposes the costs coming from domestic and import prices, and you can see that in late 2016 import prices will be slightly increasing the nominal cost, while in 2017 this positive contribution will disappear, and I think it's fair to say that this is linked to the nominal appreciation of the exchange rate, which will be a downward factor for import prices. On the other hand, the forecast assumes that foreign prices in 2017, the foreign PPI in euro area will already be growing close to its normal levels, so like 2% or something like that. So there will be offsetting factors on import price developments from these two sides. As regards The other and we work with the standard pass-through, so there is no change assumption about the pass-through after the exit. It's the standard pass-through that we are using in the model. The food prices, Tibor, would you like to comment on this?
Yeah, we were surprised with higher food price inflation than actually against our forecast. And actually, as I mentioned, we identified two main reasons. I think it was fruit and vegetables, and we linked it to import prices of food. And actually, we are having behind the forecast, we are having a forecast of import prices of goods. We are linking it to different food price commodities and the exchange rate. And actually, the maximum level will be in the, I think the maximum of food prices will be at the end of this year. And then from 2006, it's going to fall. And actually, this is explaining why, besides you can see from the comparison graph that there is a base effect there. So actually we are saying that partially this surprise, or partially this higher inflation was a surprise, but partially it's also linked to the development of imported food prices in 2016. But at the same time, we assume that agricultural prices will gradually increase over the forecast horizon. So we have got in this forecast two factors that are playing a role.
And, well, as regards the Nairu, actually, I would say that we were a bit puzzled by the previous data before the revision, which were not in line with our previous forecast. We incorporated the new data into the forecast, of course, but well, I think those data would actually be a reason to revise the Nairu estimate a bit up, which we didn't do, fortunately, because the statistical office very soon corrected the data, and I think now they're more in line with the intuition. That's why I don't think we would need to correct the previous Nairu estimate now, the one that we presented in the previous inflation report. And I think qualitatively, the fact that unemployment is approaching our estimate of Nairu is actually in line with the relatively sharp acceleration in nominal wage growth that we have in the forecast for next year. So I don't feel any strong risk of the wage growth being even faster than what we have in the forecast. I think we are already quite optimistic on that front, and well, I think we would be satisfied to see it on our own wage bill. So
I can confirm that if at the same time inflation would be revised upward, then probably that would mean that we would have to revise our estimate. But I agree with you. This information is just means that we would move with the Nairu estimate and not so much with the Nairu gap.
Thank you. So I've been listening to what Tomáš said. Nevertheless, well, it's almost 20 minutes past midday, and it was already, agreed to finish around 12. So I'm sorry, I'm not a very good manager to manage the time, but so that's why let me ask you to collect the last two questions. And I'm sorry, we are a bit behind the schedule, but I think it makes sense to clarify and but we have these discussions once in a quarter, so definitely makes sense to stay at least 5 or 10 minutes longer. Please, two last questions. One.
Marek Dřímal, Komerční banka, thank you. I have to ask this one, I'm sorry. How do you plan to handle the exit? Is there any discussion within the bank board or within the staff? Thank you.
All right, it's very clear questions. And one more question, please.
Michal Bruška, Raiffeisen Bank. You said you declined to tell us to what extent the forecast is reckoning with the Czech crown appreciation, but can you tell us exactly when the forecast expects to the Czech crown to move across 27? And maybe one question more. When the intervention regime is abandoned, will you return to the nice practice of publishing the expected, the trajectory of the exchange rate consistent with the forecast? Thank you.
Okay, so we do have 3 questions, I would say. Definitely, I'm going to answer the questions regarding how the strategy of the exit strategy will look like. But let me start with the latest question, or the last one, regarding whether once we come back to the traditional monetary policy, whether we'll come back also to present or to publish exchange rate trajectory. Definitely yes. Yes, because this is something, it's an assumption of the model, it's an assumption of the forecast. So there is no reason not to come back. Of course, we will come back. But right now it doesn't make sense because, you know, we clearly say the floor is 27. So there is no additional value added to present you right now some other, assumptions. But once we embark, on the traditional monetary policy, I would say, and monetary policy based on inflation target, based on forecast, we will again start publishing exchange rate assumption. We call it as assumption, not commitment, assumption, that's the difference. But let me come back to the first questions regarding the exit strategy. I think we have several times, already answered these questions that right now, I would say it would be premature to commit and to clearly and in more details describe how the exit will look like. Why I'm saying that? Because nobody, including me, including our, I would say, economists and people who are, working on forecast, nobody can precisely describe how economy in mid-2016 or even later, at the end of 2016, will look like once there is an exit. So really the details of exits will heavily depend on actually economic conditions at that time. And it will depend on a new forecast for 2017, 2018. It's very easy. Definitely, you always have to take, detailed steps in exits. Depends on the detail, actually, economic environment. But what I don't want to disappoint you, what I can clearly pass to you, and what I can promise that we will do our best to be as transparent as we can be, and to do everything to make it as smooth as it can be. And you know that Czech National Bank so far has been one of the most, even not the most transparent bank in the world. Once we, embark on inflation targeting at that time, and Thomas reminded me, it was 17 years ago. At that time, we were the 10 countries in the world embarking on inflation targeting. And in the small open economy so far, we don't have any other better, monetary policy regime. And from that time until now, we have been increasing in our openness and transparency. You know that we are publishing not only minutes, we are also publishing our statements, we are also publishing our detailed, we call it record communications after 6 years. Yeah, transcript. We publish, assumptions of the forecast. So what I'm saying that it's very difficult to say in more details how the exit will look like. We have had several, debates in the bank board with the experts, what we can rule it out, or how we should focus on that. But the future show us how the exit should look like. But right now there is a commitment. As I see, the commitment delivers to the market, to you analysts, to your clients. I think it's a hedge for free of charge. Yeah. And whether it will be like one step exit or several steps exits, the future will show us. But that's all what I can say. Tomáš, can you please handle the second question more?
Okay, I think the question was when the forecast expects the exchange rate to go below 27. Yeah, I think we say quite clearly that The exit in the forecast is in the first quarter of 2017, so before the exit for the rest of 2015 and for the whole year 2016, it is above or at the floor level. So I think it's quite clear. I think it should actually be also quite reassuring if the Vice Governor says that we have no further debates on how the exit will be handled, because this really confirms that we have no intention whatsoever to do a premature exit. So I think this is, we don't talk about it publicly because we don't talk about it inside of the bank, because we don't have a need to try to know everything one year in advance, because we don't see the particular situation yet, which will prevail at the time of the exit. So I think this is actually quite reassuring. There was actually one more question on the overvaluation and before November 2013. I don't think we've changed our attitude. It's still valid that the exchange rate was used mainly for inflation targeting purposes, to deliver further monetary policy easing and to cut off the risk of deflation from the economy. This is just a reassuring thing that the exchange rate was moderately overvalued and after that it moved broadly in line with fundamentals or only very mildly undervalued. But this is not the primary reason. This is something that we communicate to clarify why we don't think that there will be a fundamental strong pressure on the exchange rate to appreciate after the exit. It's not clarifying why we took the decision. It's more about communication regarding the exit and what may happen afterwards.
Ladies and gentlemen, let me close our discussions. I'm very pleased that you have come. Thank you very much for that. Thank you very much for your questions. Thank you very much for your interest in our latest forecast. And let me also thank you to our chief economist, Tomáš Holub, and our, Tibor Hledík, head of the monetary policy divisions of the forecasting team, that they have prepared, I would say this is for the first time they have prepared the forecast for next 2.5 years. So for the first time we see really in more details what we can expect in 2017. Thank you very much for that and see you next in 3 months. Yeah, please have a nice summer.